variable and absorption costing. Let's start by discussing variable costing, which is when all variable manufacturing costs, this means direct and indirect, are included as inventoriable costs. Contrast that to absorption costing. This is when all variable and fixed manufacturing costs are included or absorbed as inventoriable costs. Perhaps we can clarify things with an example. Let's do that now. This is a spreadsheet example, and we'll begin with some basic facts. We've got a description of various things for a business for the months of April and May. We'll begin with some basic unit data. We'll take a look at beginning inventory, which is 0 for the month of April and 150 units for May. Production. The business produces 500 units in April and 400 units in May. We'll take a look at ending inventory. Ending inventory is 150 units for April, which is why beginning inventory was 150 units for May. Let's take a look at sales. Sales is 350 units sold in April and 520 units sold in May. The selling price per unit is $26,000 per unit in each month. And then we can look at some variable costs. The manufacturing cost per unit produced is $10,000. Remember, this is variable costs for both April and May. The operating or the marketing cost is per unit sold, not produced. This is variable, and it's per unit sold in April and May, $3,000 for each month. If we look at our fixed costs, the actual fixed manufacturing costs incurred are $2 million in each month. The operating marketing costs, these are fixed. Again, you can think of this as marketing salary and other items, is $600,000 for each month. And they have a budgeted fixed cost per unit. This is manufacturing cost per unit of $4,000 per unit. This is based on a budgeted output level of 500 units of production. If we want to begin, we'll begin with variable costing, which remember is when a business is taking all of their variable manufacturing costs, and those are their inventoriable costs. This lends itself to an income statement that's done in contribution margin format. We'll begin with revenues. Revenue would be the number of units sold multiplied by the selling price per unit. That's 9.1 million in April and 13,520,000 in May. Now let's take a look at beginning inventory. Beginning inventory, we are told, is 0 in April. Then we can add the cost of manufacturing. Under variable costing, the cost of manufacturing are all variable manufacturing costs. So what we would do is take the number of units produced, which is 500 units, and we would multiply that by the variable cost to manufacture each unit. That works out to $5 million in April. And that works out to 4 million, which is 400 units multiplied by 10,000 a unit, 4 million units in May. We can now calculate the cost of goods available for sale under variable costing. That will be 5 million for the month of April. And then we will deduct ending inventory so we can calculate the cost of goods sold on a variable costing basis. So we will call this the variable cost of goods sold. Ending inventory would be the ending inventory multiplied by the variable cost per unit, which is 1.5 million. For the sake of presentation, I'll present it in brackets, so it's very clear that that number should be subtracted. Ending inventory for April is going to be beginning inventory for May, this will mean that the cost of goods available for sale for the month of May is 5.5 million. And once again, we will subtract the ending inventory, which is only 30 units in May, once again multiplied by 10,000 per unit or 300,000. And again, for the sake of presentation, I'll display that in brackets. We can now calculate the cost of goods sold, but remember this is variable costing, so we will call it the variable cost of goods sold. And that will be 5 million, subtract 1.5 million, or $3.5 million for the month of April. And we'll do the same for May, which works out to $5.2 million. Now, because we are using variable costing, that lends itself to a contribution margin format. We can go ahead and total up our remaining variable costs. Our operating costs were $3,000 per unit sold. So we'll multiply 3,000 by the sales of 350 units. And we get $1,050,000 for April. If we do the same for May, we get 1.56 million. And that is sales of 520 units multiplied by variable operating costs of 3,000 per unit. That means our total variable costs for the month of April is 4,550,000. If I do the same for May, 6,760,000. We can now calculate the contribution margin. Take our revenues, subtract our variable costs, and we get a contribution margin. The contribution margin for May will work out to 6,760,000. Now we can go ahead and deal with our fixed costs. Fixed costs were given in the question as fixed manufacturing costs as $2 million incurred, and that is the same for each month. And the fixed operating costs were given to us as well as $600,000, and that was the same for each month. So our total fixed costs are 2.6 million for each month. We can now go ahead and calculate operating income. And to do that, we'll take the contribution margin and subtract the total fixed costs. We get 1,950,000 for April. And we get 4,160,000 for May. Before we move on to do absorption costing, I'd like to bring something to your attention. Let's take a look at the month of April. You'll notice the business produces 500 units, but sells 350 units. Under variable costing, all of the fixed costs are expensed in the period. So in a scenario like this, operating income is going to be lower because the fixed cost associated with the higher level of production do not end up going to ending inventory. This means that all fixed manufacturing costs get expensed in the period. This ends up making operating income lower because none of the fixed costs end up in ending inventory, which is a balance sheet account. Here, all of the fixed costs related to manufacturing end up on the income statement. Now, let's move on to absorption costing. The scenario is going to be the same. So let's begin with revenue. Our revenue will once again be the number of units sold multiplied by $26,000 a unit. And we do that for each month. Now, we are not going to calculate the variable cost of goods sold. Instead, under absorption costing, we calculate the cost of goods sold as you are used to doing, with variable and fixed manufacturing costs included in the amount, because we are going to be creating a gross margin statement. Let's begin with beginning inventory. Beginning inventory was 0. Then we can have our variable manufacturing costs. Our variable manufacturing costs are equal to the number of units produced multiplied by the variable manufacturing cost per unit. And then we can deal with what was allocated to our inventory during production. The business produced 500 units, and we'll multiply that by the allocation rate, $4,000 of fixed manufacturing costs per unit. That equals 2 million. So the cost of goods available for sale are $7 million for April. We can now subtract the ending inventory. And to subtract ending inventory, we can take the variable cost of 10,000 per unit. We can add the fixed costs of $4,000 per unit and multiply that, 14,000, by the number of units in ending inventory, which is 150 units. And for the sake of presentation, I will present that with brackets so it's very clear that this is to be subtracted. Now, because the business is using normal costing, we should deal with any under or over allocated overhead. The business budgets $2 million in fixed manufacturing costs. They also incur $2 million in fixed manufacturing costs. So there's no rate variance to speak of. So the entire amount of any under or over allocation will be a production volume variance. Anyways, as we can see, the business allocates 2 million and they incurred 2 million. So there is nothing here to deal with. We've got zero difference. What does that mean? It means their cost of goods sold is going to be $4,900,000 for April. Let's do the same for May. Beginning inventory for May will equal the ending inventory from the prior period. Then we can look at variable manufacturing costs, which will be 400 units made multiplied by $10,000 a unit in variable manufacturing costs, which is $4 million. And then we can look at the fixed costs that are allocated during the period. Again, they made 400 units, and we'll multiply that by their fixed manufacturing cost allocation rate of $4,000 per unit. We get 1.6 million. This means the cost of goods available for sale for the month were 7,700,000. We should then subtract ending inventory, which is going to equal the $10,000 in variable cost per unit plus the $4,000 allocated in fixed cost per unit multiplied by the number of units in ending inventory. I'll present this in brackets so it's clear we are subtracting the amount, and we get 420,000. Now, one last thing to be aware of is that because the business was using normal costing, there is a difference between the actual manufacturing costs incurred, which was 2 million, and the fixed manufacturing cost allocated, which is 1.6 million. We should deal with that variance. So we'll take 2 million of what's actually incurred, subtract what was allocated. There's another $400,000 here that needs to be dealt with. And for the sake of simplicity, we will just put the entire amount to the cost of goods sold. This means the cost of goods sold for May is going to be 7,680,000. We can now go ahead and calculate the gross margin. For April, it's going to be 9,100,000 in revenue. Subtract the cost of goods sold gives us $4.2 million. For May, we will take 13,520,000 and subtract 7,680,000 in cost of goods sold, and we get 5,840,000. Now we should subtract all operating costs. These are period costs. So for variable costs, we'll take $3,000 per unit sold multiplied by 350 units sold. And the fixed operating costs incurred were $600,000. We'll do the same here for May. We'll take the $3,000 in operating costs multiplied by the number of units sold and the fixed operating costs incurred, and we can total them up. And now we can calculate our operating income under absorption costing. We'll take 4,200,000 in gross margin, subtract the total operating costs, and we get $2,550,000. Let's compare that here. 5,840,000 in gross margin, subtract 2.16 million in operating costs, gives us an operating income of 3,680,000. So what we want you to start to see is that in a month when sales, here, let's take a look, sales of 350 units is less than production of 500 units, absorption costing is going to give you a higher operating income because all of the fixed costs are allocated to inventory, and some of that inventory is not sold. So it sits on the balance sheet instead of getting expensed in operating costs down here. If we look at another period, let's say the number of units produced are fewer, 400 units, compared to what was actually sold, 520 units, the operating income will be lower when compared to variable costing. This is because the cost per unit is higher, and so more of those units are sold, meaning the cost of goods sold will be higher. In other words, the entire difference is due to how the fixed manufacturing costs are treated. We can prove that by reconciling the two. Let's do that down below. We'll take a look at the month of April and May, and we'll compare the operating income under each method. I've already listed here the operating income under variable costing was $1,950,000 for April and $4,160,000 for May. If we take a look at the operating income for absorption costing, it was $2,550,000, meaning a difference between absorption costing and variable costing was $600,000 in operating income. How do we reconcile that difference? Well, let's take a look at the fixed costs in ending inventory in the month of April. In the month of April, we have fixed costs of ending inventory that we can calculate. We know that there's 150 units in ending inventory. We can multiply that by the budgeted fixed cost per unit, and we get $600,000. The fixed costs in beginning inventory, well, the business didn't have any beginning inventory in April. And so if we want to compare, we can see that there's a $600,000 difference in the fixed costs in ending inventory versus beginning inventory under absorption costing, which is exactly the difference in operating income between absorption costing and variable costing. Said another way, this $600,000 difference is fully expensed under variable costing, which is why the variable costing operating income is literally $600,000 lower. Now let's look at the month of May. If we look at the operating income under absorption costing for May, it is $3,680,000. The operating income under variable costing was higher. It was $4,160,000. meaning we have a difference of negative 480,000. Let's see if we can explain that by looking at the fixed costs in ending inventory under absorption costing. Under absorption costing, we know for this business, they were allocating 4,000 per unit. And in ending inventory, they had 30 units in the month of May. That's 120,000. If we look at the fixed costs in beginning inventory of May is ending inventory of April. If we compare the two, we can see the difference is 480,000. And so once again, you can see that it reconciles, meaning the difference between the two is fully explained by the difference in how fixed manufacturing costs are dealt with under absorption costing. So why does this matter to you? Well, you need to be aware that a manager might be tempted under absorption costing to overproduce. They might produce more than they need on a consistent basis because that would result in higher operating income. I hope you found that helpful. Until next time, I will say thank you for watching and may your journey be joyful.
Yo, gather round, it's time for a lesson. We're talking cost methods in the session. Variable versus absorption style. Accounting tactics that'll make you smile. Variable costing, keeping it straight. Only variable costs, we don't inflate. Absorption costing, take it all in. Fixed and variable cost, that's how we split. Let's kick it off with variable flair. Only variable manufacturing's there. Direct, indirect, they make the team. Inventoriable costs, you know what I mean. Fixed manufacturing, we expense it quick. Right to the income statement, that's the trick. Operating income might seem low, but transparency's the way to go. For variable costing, keeping it straight. Only variable costs, we don't inflate. Absorption costing, take it all in. Fixed and variable costs, that's how we spin. Switching gears to absorption mode. Our manufacturing cost carry the load. Variable plus fixed, they get combined into inventory costs, all aligned. Fixed costs deferred until we sell, boosting profits, ringing that bell. But be cautious of the tale it tells. Higher income might cast some spells. But variable costing, keeping it straight. Only variable costs, we don't inflate. Absorption costing, take it all in. Fixing variable costs, that's how we spin. April production's on the rise. 500 units made before our eyes. Sold 350, the rest we stash. Ending inventory, that's our cash. Under variable fixed cost, our out expenses up front without the doubt. Operating income takes a slide, but reflects the cost we can't hide. For variable costing, keeping it straight. Only variable costs, we don't inflate. Absorption costing, take it all in. Fixing variable costs, that's how we spin. May comes around, a different scene. 400 units made, you know what I mean. When sales jump up to 520 sold, inventory drops, a stories unfold. Absorption shows a lower gain. Fixed cost expense, it feels the strain. Variable costing lifts the veil. Higher income without fail. For variable costing, keeping it straight. Only variable costs, we don't inflate. Absorption costing, take it all in. Fixed and variable costs, that's how we spin. The difference lies in cost allocation. Fixed costs change with inventory fluctuations. Managers might overproduce to pump up income at fixed reduced. So what's the moral? Keep it tight, know your costing method's right. Variable shows you the real deal. Absorption might just conceal. Make informed decisions, that's the key. In accounting and in strategy. Whether you choose method A or B, understand the impact financially. For variable costing, keep it straight. Only variable costs, we don't inflate. Absorption costing, take it all in. Fixed and variable costs, that's how we spin. Now you're versed in costing ways. Useless knowledge in your days.